In this video, we're going to give you a quick overview of the common financial statements that companies use to report on the performance of their business over a period of time. Finance is really the common language that's used in business to tell that story. And who are we telling the story to? People that have a vested interest in understanding what's going on at the company. And here are just a few. Within the company, the owners want to know if they should stick with it or take their money and go somewhere else. Managers want to know if what they're doing is actually helping the company make money. And outside the company, suppliers, lenders want to know if they should keep doing business with the company. Customers only want to conduct business with a good, solid organization that they can trust to be there for the long haul. Our objectives in this discussion are to review how a company makes money and how they demonstrate this to the various stakeholders in the business. And we'll talk about the three main financial statements: the income statement, the balance sheet, and the cash flow statement. And we'll also talk about how cash is not always the same thing as profit. And let's start with that. Let's talk about what cash really tells you and what it doesn't tell you. Let's say that you have a company, and as you run it over a period of time, some cash flows in and some cash flows out. And you issued stock, which brought some cash in. You sold some stuff, borrowed money from a bank, and cash came in from all those activities. And let's say in the same period that you paid salaries, you bought a new plant, you did some marketing, and cash went out from those activities. And when you net that out, the inflows and outflows, let's say that your net cash flows in the period were negative $53,000. Uh-oh, that sounds kind of bad, right? Because it's negative. Or is it bad? What if you had started with $10 million in cash? Then a negative $53,000 doesn't sound that bad, does it? But what if you had started with $100,000? That's a different story again. But just by looking at cash flows alone, important though that is, it wouldn't have told you that information. And what about the assets that you own or the money that you owe? To understand those things, we also need to look at the balance sheet to get that information. And what about profit? Are all of these cash flows impacting profit? We need more information because interest on these flows is an expense that impacts profit, but dividends are not an expense even though they're an outgoing cash flow. So to really understand the story being told about the company, we need more than just cash flows. We need the other financial statements to actually complete the picture. So at the highest level, the income statement compares revenue and expenses associated with selling your product over a defined period of time. And the balance sheet shows what the company has in assets at a point in time and who owns those assets and how you got those assets. That is, what are the liabilities and the equity at a point in time. And the cash flow statement really is not even a separate statement, actually. It's just a little more detailed. It's the worksheet that you had to do to determine the cash line item on the balance sheet.